For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you very much, Brandy.
So as 2021 wraps up, what can you share that stands out to you in the money management world that maybe isn't getting the attention it deserves in the mainstream media?
Yes, unfortunately, kind of a boring topic probably to many individuals, but an important one as far as if you're investing. ETFs, exchange-traded funds, not necessarily new. They've been around about 20 years, but pales in comparison to mutual funds going back almost 100 years. ETFs, exchange-traded funds, have a few advantages as far as that mutual funds don't have, and subsequently, the amount of money that's been flowing into it is just off the charts. The chart I brought along today is going to illustrate as far as month by month, as far as net inflows going to ETFs. And this net inflow, we're looking at anywhere from $40 billion in a given month to $100 billion, amounting to about $880 billion of new flows going into ETFs. Now, much of that, unfortunately, if you're in the mutual fund business, unfortunately, a lot of that came at the detriment as far as of the mutual fund world. That money came out of mutual funds, much of that money, and it made its way into exchange-traded funds.
So what is it about this type of structure that has drawn investors to it?
So I think it's primarily centers around two big items. The first one is they trade like stocks. So for many people, this may not be that big of an issue because, again, they're not actively trading day to day or hour to hour. But for individuals that would like that flexibility to be able to enter the market when they want to, not at the end of the day. Mutual funds is always at the end of the day. No matter when you invested the money, it's the close of that day as far as when that money is going to go in. The other is tax efficiency. So this one gets a little bit more complicated, but big picture, mutual funds, as far as when the mutual fund manager buys and sells stuff as far as on your behalf in that mutual fund, all of those transactions either have a gain attached to it or they have a loss attached to it. And at the end of the day, that all has to be accounted for at the end of the year. So when you have a pretty decent year like we've had, and last year was pretty decent as well, all of that has to flow to the investor. So in other words, even though you didn't necessarily take that money in the form of a distribution, you left it in there reinvested, you're going to have to pay taxes on that money if it's in non-IRA accounts. So in other words, after-tax accounts. So a big difference. With ETFs, you don't have that you have to deal with each and every year. So it's much more flexible, and from a tax efficiency standpoint, much better.
All right, David, as always, thanks for taking the time to talk with us.
Thank you, Brandy. Appreciate it.
If you missed any of our discussion, we'll make it available for you on ourquadcities.com.